the silence is deafening. The massive burns that once fueled the Shiba Inu narrative have vanished. Activity has hit absolute zero, and the token's core deflationary mechanism is now facing its most critical test. What happened to the trillions of tokens promised to be destroyed? Is this a temporary lull, or has the entire burn strategy collapsed, leaving the Shiba Inu supply bloated and its price vulnerable? Let's dive into the data and expose the truth behind the burn rate crisis. Welcome to Dr. Crypto, your daily serving of Shiba. This is the spot for you if you're curious about anything related to Shiba. If you want to keep informed about all the latest news forecasts and stay ahead of the crypto industry, subscribe. To get more Shib news, be sure to click the like button. Please note that by the time you see this video, some rates may have changed. Financial advice is not included in this video. The Shiba Inu burn mechanism is the single most important component of its long-term value proposition. With a massive initial circulating supply, the community and developers introduced a system designed to perpetually reduce the token count, creating scarcity and driving up the price. This deflationary strategy was formalized with the introduction of Shibarium, the Layer 2 blockchain, which automates burns by allocating a portion of its transaction fees to permanently remove Shiba Inu from circulation. The mechanism was meant to be a continuous, self-sustaining engine of value creation. However, as of late 2025, the mechanism is under intense scrutiny. The entire premise of Shiba Inu's tokenomics, that supply reduction will eventually force a price increase, is being questioned as the burn rate has failed to keep pace with the market's expectations and the token's sheer volume. This background is crucial to understanding why the current near-zero burn rate is causing such widespread alarm and leading to questions about the mechanism's viability. The main event is the dramatic and sustained collapse of the Shiba Inu burn rate, which has led to a crisis of confidence in its deflationary model. According to community trackers, the burn activity has plummeted to near-zero levels, with one report showing that only 988,032 Shiba Inu were burned over a recent 24-hour period. Even more alarming, other data sources indicate that the few days ago, burn rate hit absolute zero in a 24-hour window with a mere 552 tokens sent to dead wallets. This is a catastrophic failure of the mechanism, especially when compared to the massive, multi-billion token burns that were common in earlier phases of the ecosystem's life. The drying up of large voluntary burns, combined with the insufficient volume from the automated Shibarium mechanism, has created a perfect storm. The market is now grappling with the reality that the deflationary engine has stalled, directly contradicting the core narrative that has sustained the token's valuation. The market's reaction to the burn mechanism's failure is one of deep skepticism, directly translating into bearish price action. The token's price has struggled to find a floor, with the lack of a credible deflationary narrative removing a key pillar of investor confidence. When the burn rate hit zero, the price immediately reacted, dropping by over 2% in a short period, as selling pressure intensified. The failure of the burn mechanism has directly eroded the scarcity-driven value proposition of Shiba Inu. Instead of being driven by structural deflation, the price is now overwhelmingly dictated by speculative demand and broader macroeconomic forces. This is evident in the token's recent performance, which has seen it underperform compared to other meme coins that have managed to maintain a more consistent supply reduction strategy. The market is effectively pricing in the failure of the burn mechanism, viewing the token supply as effectively static, which removes a major catalyst for future price appreciation. The on-chain and technical evidence provides a stark confirmation of the burn crisis. Data reveals a devastating 96.96% drop in weekly burn activity compared to prior periods, a clear sign that the mechanism has collapsed. This collapse is not a temporary fluctuation, but a structural problem. While there was a massive short-lived spike in the burn rate on December 19th, which saw a surge of 3,915,071.74%, this only resulted in the removal of approximately 21 million Shiba Inu. This highlights a critical flaw. Even a massive percentage spike in activity is insufficient to make a meaningful dent in the token's quadrillion-level supply. Analysis shows that the Shibarium Layer 2 solution, which was designed to automate burns by allocating 70% of its gas fees, is simply not generating enough transaction volume to be effective. Although Shibarium has processed over 1.5 billion transactions since its launch, the volume of Shiba Inu burned is negligible in the context of the total supply. This technical evidence confirms that the mechanism is symbolic rather than substantive, failing to create the necessary scarcity for a price recovery. Analysts are now openly debating whether the deflationary mechanism is a complete failure. Expert commentary suggests that the collapse in burn activity is not merely a technical glitch, but a reflection of waning community participation and a lack of financial incentives for token holders to engage in burning. The implication is that the mechanism has become a victim of its own design. Without a significant price increase, there is little incentive for users to pay the gas fees required to burn tokens, creating a vicious cycle. The failure of the burn mechanism should be a central consideration in all bear case models for 2026. Without renewed large-scale burning, Shiba Inu's price is unlikely to stabilize, as its core deflationary narrative has lost credibility. The structural weakness exposed by this crisis leaves the token vulnerable to liquidation pressure and speculative trading rather than organic demand driven by scarcity. The consensus among a significant portion of analysts is that the tokenomics are fundamentally flawed without a massive external catalyst to drive Shibarium adoption and, consequently, burn volume. The community's reaction to the burn crisis is one of frustration and divided opinion. The Shib army, while still vocal, is increasingly questioning the effectiveness of the Shibarium-based burn mechanism. On social media, the focus has shifted from celebrating burns to demanding transparency and a more aggressive strategy from the development team. Developer hints have emphasized the long-term vision, stating that the burn rate is directly tied to the utility and adoption of Shibarium. The argument is that as the ecosystem grows and more D-apps are built, the transaction volume will naturally increase, leading to a higher burn rate. However, analysts note that the platform's ability to attract high-quality D-apps remains unproven, and the current low burn rate suggests that the utility is not materializing fast enough to save the deflationary narrative. The developers are relying on a build it and they will come strategy, but the community is demanding immediate, tangible results to restore confidence in the token scarcity model. The forecast for Shiba Inu is now inextricably linked to the revival of its burn mechanism. The immediate outlook is grim. Analysts predict that the burn rate will remain stagnant unless a major, coordinated community event or a significant Shibarium upgrade is announced. The price is expected to continue its struggle, with the lack of deflationary pressure compounding the bearish sentiment. The long-term forecast is highly speculative. Bullish scenarios, which project Shiba Inu to trade at an average of 464 units in 2026, are entirely dependent on a massive acceleration in Shibarium adoption and transaction volume. However, a significant number of analysts, citing the token's speculative nature and the failure of the burn mechanism, are advising selling Shiba Inu in 2026. The 3-year outlook hinges on the success of the Shibarium ecosystem in generating real-world utility and transaction volume that is substantial enough to burn trillions of tokens, not just millions. Investors must watch the Shibarium transaction volume as the single most important metric, as it is the only path to a sustainable burn rate. A balanced opinion on the burn crisis must acknowledge the severity of the situation while recognizing the potential for a strategic pivot. The primary risk is the complete loss of the deflationary narrative, which would relegate Shiba Inu to a purely speculative asset with no structural mechanism for supply reduction. The cautionary point is that the current burn rate is insufficient to make a difference, and the reliance on Shibarium's growth is a long-term gamble. The neutral insight is that the developers have successfully built the infrastructure for an automated burn, but the execution is failing due to low demand for the Layer 2 solution. The tokenomics are not inherently broken, but the ecosystem's utility is not yet strong enough to fuel the mechanism. Investors should view the current situation as a critical stress test. If the burn rate does not significantly increase in the first quarter of 2026, the deflationary mechanism can be considered a failed experiment, and the token's long-term prospects will be severely diminished. The Shiba Inu burn mechanism is on life support, and the market is watching to see if the developers can pull the plug or revive the patient. The current near-zero activity is a stark warning that the deflationary dream is fading. The only hope lies in a massive surge in Shibarium utility. Until then, the supply remains bloated and the price remains vulnerable. Stay vigilant, track the burn rate, and remember that tokenomics are only as strong as the ecosystem that supports them. The day is over now. Remember to give it a big thumbs up. To see our most recent material, share it and subscribe to the channel.